Hello, this is Professor Hazara again, and this is the second video of this problem, which has both non-controlling interest and is beyond the year of acquisition. This is the second year problem. Anyway, so let's get on with it. And in the first video, I showed you the text of the problem, and basically it's a very simple problem. You have one company that pays $480 on January 1st, 2011 for the stock of a company, for a company with $450,000 in capital, $400,000 capital stock, $50,000 retained earnings. The goodwill is only assigned, part of the goodwill, part of the excess is assigned $100,000 to undervalued assets for your life and goodwill. And there's a couple of intercompany receivables, payables, and then one of the big things, the problem is that it was, is an old CPA problem. They threw in a $20,000 mistake. So the investment account is going to be a little different than the calculation, so they won't exactly match. That was because in the problem they assumed that they have a dumb account and that they forgot to record a dividend that was declared by the subsidiary at the end of the year. So anyway, let's get started here with the worksheet. And in this video, I will go over the calculations for you. Okay, and one more thing, I'll do all the calculations here in this video. In the next video, I'll do the journal entries, consolidation entries, and the final entry video, I'll do the consolidation itself. Okay, so the cost is, let's go back to the text here. The cost is $480,000, and they acquire an 80% interest. So we'll just figure out the total cost of the company here. This is $480,000. .80 interest. So if you take 480 and divide by 80%, that means that the full company is worth $600,000 in the market from the view of the parent. Next, net book value. Well, the problem tells you in the text, the problem, like over here, they have $400,000 capital stock and $50,000 in retained earnings. So over here, they have common stock of $400,000 and retained earnings of $50,000. Okay, and I'll just go down. I'll make the 100% column, then I'll split it up 80, 20, 80, 20. Okay, so the total value of the company is going to be a negative 400,000 plus 50,000. So negative $450,000. Okay, so the difference, your overpayment, your valuation differential, whatever you want to call it, is $150,000. Make that into a 0. Now, how is that split? It tells you in the text of the problem. Let's go back to the text. Text of the problem tells you that the excess of fair value over book value was allocated to $100,000 to undervalued assets, plant assets, and the remainder to goodwill. So they're just telling you how it's split up. You don't have to do any calculations. So minus 100,000 goes to plant assets. Not a million. Minus 100,000 goes to plant assets, and the remainder goes to goodwill. Okay, now let's just go ahead and split that 80 and 20. So we'll take 600,000 times, or 80% times 600,000. That's 480. We'll just go ahead and freeze this, and we'll copy down. Okay, so that looks pretty good. We'll put an underline there and an underline there. Okay, now we'll do the 20%, the non-controlling interest. So we'll take 20% times 600,000, obviously 120,000. Once again, we'll just freeze the cell and Copy down. Okay, and so what you got here is you've got the costs is split 480/120. Book value is 316.90. Difference 120.30. Plan assets 80,000 of the revaluation goes to controlling interest, 20%, 20,000 goes non-controlling interest, and goodwill is also split 40,000, 10,000. Okay, now just to start finishing these calculations here is let's go ahead and calculate the amount of excess depreciation that we're going to have on plan assets. In other problems, you could have inventory, you could have equipment, all sorts of things. In this problem, they're trying to keep it simple because we want to concentrate on the multi-year aspect of the problem. Okay, now if we go back to the text of the problem, it says that the plan assets, the undervalued plan assets had a 4-year life. So we're going to take that 100,000 and write it off over 4 years. So let's just do this. 80,000 divided by 4. For the majority, non-controlling interest, they're going to be getting hit with an excess expense of 20,000, and the minority or non-controlling interest, they'll get hit with an annual expense of 5,000, and the total is 25,000. So the total is 100,000 divided by 4 gives you 25,000 split 25. Okay, now let's go down to net income. Now this is something that I've been trying to emphasize, is that the best place to get your net income from and your dividends and your beginning retained earnings is the subsidiaries' financial statements on the worksheet. They're complete. And since this is the 2012 problem, this will be, as I show there, 2012 net income, and you should get it from the subsidiary's 2012 income statement. So let's go down, and let's see right here is your income for the subsidiary for this year, for 2012, was $120,000. Controlling share of net income, it's really right there. Okay, so 120,000. Okay, we'll do split 80%, 10%. That's their share. Okay, and then I'll go ahead and underline both of these because this is going to be a product. Okay, so 120,000 times 80% gives you 96,000, and 120,000 times 10% gives you 12,000, obviously. Okay, now what we've got to do is we've got some excess depreciation to bring down. So we're going to bring down 20,000 for the parent, and we'll bring down 5,000 for the non-controlling interest. Okay, so and this is going to be a subtotal. So the non-controlling interest has net income of $96,000 before adjustment, but because they wrote up the asset, they're going to take a $20,000 hit in excess depreciation. So their final income is $76,000, and the income for the non-controlling interest is $7,000. Just want to make sure that that number is correct before I go on here. One correction, that's 20%, not 10%. Didn't ring a bell there, but the income for the non-controlling interest is $19,000. Okay, we'll finish this video with the analysis of the investment account. Now there's 4 items in the investment account: common stock, retained earnings, buildings, goodwill. We're splitting this whole calculation beginning of year, end of year. So everything above this line is a beginning of year. Everything below the line is end of year. Now, how do I identify these items? I keep telling you, go back to the goodwill calculation up here, and it always starts with your equity items, common stock and retained earnings. So I picked up the common stock and retained earnings. There they are. And then any assets that were written up, including goodwill. Then there's only two assets that were written up, plant assets and goodwill. And that's where I get buildings, which really should be plant assets. Call them whatever you want, doesn't matter. And goodwill. So that's where I got the 4 items. If you always do the same thing, pick up the equity items and then just start after the difference, and any items that were revalued, list them down. That's what it'll be. That's what might possibly be in the investment account. Okay, so this is, let's say that this is the 100% column, and these two are the columns for the 80 and 20%. Okay, so we'll split them later. The 100% column is going to be common stock of 400,000. Now, that was the common stock goodwill calculation was made at January 1st, 11, and I've said that everything above this line is January 1st, 12. We assume in this class that common stock doesn't change, so that's based on assumption. Now, retained earnings at January 1, we can't use those because those are retained earnings at January 1, 11. So what we'll do, and once again I emphasize this, go down to the statements. The January 1, 12 retained earnings will be right there, 100,000. Those are your beginning retained earnings for the subsidiary for the year. So that's 100,000. Use those. And you notice that they should be, they're double the retained earnings of last year because the subsidiary had income and dividends, whatever. Okay, the plant assets. Now, the plant assets, the basic plant assets are equal to 100,000. That's the amount you wrote up plant assets by. However, we're working at the beginning of 2012. The acquisition took place in 2017. That means that plant assets were written down in 2011 by $25,000, which is the sum of the 20,000 and the 5,000. So as of the beginning of 2012, you should take out the total amount of depreciation, and I'm just using these two numbers. You should take out 25,000 because at the beginning of this year, you had they would have started at 1/1/11 at 100,000. Then you wrote them down by 25, so now they're worth 75,000. Okay, so we'll split 75,000, 80/20 there, and the goodwill stays on the books unless it's impaired. Okay, so here's what you got: 80% times 40,000, 32,000. 100%, 80% times 100,000. So your retained earnings are worth 80. 80% times 100,000 minus 25,000. That should give you 60,000, I believe. And then finally, 80% times 50,000 is 40,000. Okay, so you got those right there. Okay, then next one is 20% times 40,000 gives you 80,000, 20%. Then 20% times 100,000 is obviously going to give you 20,000. Then 20% times 100,000 again. No, 75,000. What am I saying? It's 20% times 100 minus 25 gives you, should give you 15,000. Let's try that again. 20% times 100,000 minus the 25. 15,000. Don't know what happened to the other one. Same equation, it seemed like. Okay, and then finally, goodwill is 20% times 50,000 or 10,000. Okay, so we'll go ahead and let's go ahead and sum these up. So got in there, but summing them up. So your beginning investment balance was $500,000, and your beginning non-controlling interest was $125,000. Okay, now in order to update them for the year, we have to add the net income for each, and we have to take out the amount of dividends for each. Now, you have to ask yourself, how much did the subsidiary pay in dividends this year? Once again, the best place to get it is from the subsidiary's financial statements. So we'll go down here and it says dividends, $40,000. The subsidiary paid $40,000 in dividends. So the parent share of that would be obviously $32,000 negative, and the subsidiary share is going to be obviously $8,000 negative. Okay, so the parent's ending balance in the investment account should be $500,000 plus 76 plus 32, $544,000. $125,000 for non-controlling interest plus 19 plus 8,000. 136 is what the subsidiary's ending or the non-controlling interest should be. And then one more thing is you should match up both the income and the investment account with their balances on the financial statements. The income matches up. There's your 76 income from sub. We go down to the parent's income statement, and there's your 76 income from sole. They match. But then you come down here to the parent, and you're saying, and this is correct, by the way, that their income, their investment account should be 544. But we come down here and we find out that their investment is 560. So there's a $16,000 difference, and I wouldn't worry too much about it because it goes back to, and I'll start in the next video talking about this, but it goes back to the problem here, where it says that a $20,000 dividend was declared by Cy, but was not recorded by Pat. And they could put not recorded by Pat using the equity method. They forgot to make an equity method journal entry. And the amount off was $16,000, which is 80% of that $20,000. So that gives you a big hint there. Anyway, I'll start the next video with that, through the journal entries. Okay. Thank you very much.